Imagine a blockbuster film is set to release next month, and you anticipate that tickets will sell out instantly while prices skyrocket. The buzz is everywhere, and you know that securing a seat at the premiere will soon become an incredibly expensive endeavor. Instead of purchasing a ticket at current market rates, you decide to acquire a special reservation voucher that guarantees you a fixed price. This voucher acts as a protective barrier, locking in your cost regardless of how chaotic the box office demand becomes later on. It gives you the explicit right to buy a ticket for $10 next month, even if the price jumps to $50. This simple scenario serves as a perfect introduction to the world of stock options, which are essentially complex financial contracts. These contracts provide the holder with the right, but not the obligation, to buy or sell an asset at a predetermined price. Think of it as a strategic tool that allows you to control a large amount of stock without needing to own it outright. Crucially, this transaction must occur before a specific expiration date, which adds a layer of time-sensitive strategy to the entire process. If the date passes and you have not used your voucher, the contract simply expires, and your initial investment is gone. By purchasing this contract, you are securing choice and flexibility in the market, rather than immediate ownership of the underlying stock itself. This foundational concept sets the stage for more complex trading strategies, allowing investors to navigate market volatility with far greater precision. Now, let us look closer at the two primary types of options that every trader should understand before they get started. First, we have the call option, which is designed for those who believe that a stock price is headed significantly higher. When you buy a call, you are essentially betting that the market will move up, allowing you to profit from the growth. On the other side of the spectrum, we have the put option, which is the exact opposite of a standard call. A put option allows you to profit if you believe a stock price will go down, providing a way to hedge. It is a powerful mechanism that lets you benefit from market declines, which is a unique advantage in the trading world. If the market moves in your favor, you can cash in on the difference between the strike price and current value. However, if the market does not move in your favor, the contract simply loses its value as the expiration date approaches. The beauty of this system is that your potential loss is limited to the small fee you paid to buy it. This limited risk profile is exactly why many investors find options so attractive compared to buying stocks directly with cash. But do not let the simplicity fool you, as these instruments require a deep understanding of how time affects their value. Every day that passes brings the contract closer to its expiration, which can rapidly change the price of the option itself. This phenomenon is known as time decay, and it is one of the most important factors for any serious options trader. As you gain experience, you will learn how to balance these risks and rewards to build a more resilient investment portfolio. Think of options like financial superpowers. They offer massive leverage and flexibility, but they come with high risks for the unprepared. You must always be cautious, as the same leverage that amplifies your gains can also quickly multiply your potential losses. Before you dive into trading, ensure you have a solid grasp of the underlying assets and the specific rules of options. Knowledge is your best defense against market volatility, and taking the time to learn the mechanics is a wise investment. The market is constantly shifting, and having the right tools at your disposal can make all the difference in your success. Options are not just for experts. They are for anyone willing to study the logic behind the price movements and risks. By understanding the reservation voucher analogy, you have already taken the first step toward mastering these complex financial instruments today. Keep practicing with paper trading accounts to see how these theories play out in real-time market conditions without risking capital. Mastering the basics of calls and puts will provide you with a framework to analyze almost any market situation effectively. Always remember that every contract has a buyer and a seller, and understanding the seller's perspective is equally valuable here. As you continue your journey, keep an eye on how volatility impacts the premiums you pay for these various contracts. Volatility is essentially a measure of how much the market expects the stock price to swing in the near future. Higher volatility usually means higher option prices, as the potential for a large move increases the value of the contract. This relationship between volatility and price is a cornerstone of professional options trading and requires careful attention to detail. As you become more comfortable, you might explore more advanced strategies like spreads, which involve buying and selling multiple options. Spreads can help you manage your risk even further, allowing you to define your maximum profit and loss very clearly. It is all about building a strategy that aligns with your personal financial goals and your tolerance for market risk. Never rush into a trade without having a clear plan for both the best case and the worst case market scenarios. The goal is to remain disciplined and patient, letting the math work in your favor over the long-term period. Trading is a marathon, not a sprint, and those who prioritize education tend to see the best results over time. Stay curious about the markets, and keep questioning how different economic events might influence the stocks you are watching closely. There is always something new to learn in the world of finance, and that is what makes it so exciting. Whether you are hedging your existing portfolio or looking for growth, options offer a unique set of tools for investors. Take your time to digest these concepts, and do not be afraid to revisit the basics whenever you feel uncertain. The more you practice, the more intuitive these concepts will become, turning complex math into second nature for your trading. We are here to help you navigate these waters, providing the clarity you need to make informed and confident decisions. If you found this explanation helpful, consider sharing it with other investors who are also looking to expand their knowledge. Building a community of informed traders is one of the best ways to ensure everyone grows and learns together effectively. We will continue to break down these topics into manageable pieces, ensuring you have a strong foundation for your future. Stay tuned for our next deep dive, where we will explore the Greeks and how they influence your option pricing. The Greeks are the mathematical variables that help you understand how your options will react to different market changes. They are the final piece of the puzzle that will transform you from a beginner into a truly sophisticated trader. Thank you for joining us on this educational journey, and we look forward to seeing you in the next video. Hit subscribe to master the market step by step and join our growing community of investors dedicated to financial literacy and success.